the students who put it together. This is a really great event and some amazing panelists who are going to participate today. I'll try to talk for about 20 minutes now and give you a bit of an overview of how we think about the financial services world. I'll leave some time for questions at the end. If you have any really hard questions, please keep them to yourself. Otherwise, I'd be happy to answer. So first, some wise words from Paul Samuelson, and a few reasons why I use this quote to start. The first is because Paul Samuelson wrote my first economics textbook, so I always, won the Nobel Prize too, but I always remember him for that. And today is Paul Samuelson's birthday, or would be his birthday. He passed away a few years ago, but he would be 100 today. And secondly, he mentions Las Vegas in the quote. It's actually also Las Vegas's birthday today. 110 years old since the parcel of land was first granted to the developers who started to build Las Vegas. And then lastly, I think he says something really important about investment and innovation that we should pay attention to here. And it's kind of easy to forget in these heady times in Silicon Valley where you have Uber at $40 billion, started a handful of years ago, and scores of other companies that are becoming worth more than $1 billion all the time. Which is that the process of developing a view of investing, of choosing the company that you want to start or that you want to work with is a very long-term process, and doing it well requires thinking about, I would argue, requires thinking about the thematic trends and the waves that are going to change industries over time, and then figuring out how to situate yourself on one of those waves. So when we started Ribbit Capital a little over 3 years ago, we'd spent a lot of time prior to that thinking about the wave that's coming in financial innovation. I'll talk about that some today. Just so you have a little bit of background on our firm, Ribbit is an investment firm that focuses solely on backing entrepreneurs around the globe who are trying to change the way consumers and small businesses get financial products. And so far, we've been doing it for a few years. So far, it has been a lot of fun. But when you start this kind of firm, you have to start it with really strong views. So this is really just a quick background to tell you that whether you agree with anything I say or not, you think I'm totally full of it, at least we are putting our money where our mouth is. So as a way of starting, I'm going to kind of give you a pocket history of the last 40 years of financial innovation, and you're going to have to just forgive the sweeping generalizations for the sake of the narrative here. I would argue that during this period, and we're kind of entering the third one now, which I'll talk about. We've had 3 waves of financial innovation, and in the 70s and 80s, the first one, you really had this sort of huge growth in financial services accompanied by the growth of the middle class, and I call this period democratization, because during this period, we had a sort of massive growth of financial products that served people who had never been served in the formal financial system before, or who were just keeping their money in banks. And actually, we had a lot of very useful innovation. So, I'm sorry, just went one ahead here, 2 ahead. So you had money market funds. You had the emergence of more and more people investing in index funds and the equity markets. You had the advent of electronic payments, a really core innovation. And some of this ended up, not all of this was good, and some of it, during that period and later ended up in excess. But really an interesting time for financial innovation, and a lot of good things came out of it. Now, if I'm generalizing, I call the next period, kind of on a cynical day, I would call this exploitation. This is a sort of a period where the financial industry became really good at making things that it had innovated before increasingly complex. And we had a lot of so-called innovation. I put it in quotes because there's a lot of debate about whether this innovation was actually productive or good, led to improvements in people's lives and in the economy. To take the sort of most notorious, you look at the synthetic CEOs or SIVs, this is what passed for financial innovation during this period. During this period, banks did remarkably well. Leading up to kind of once the people had the fog had cleared after the savings and loan crisis, you started this period of consolidation and growth for the large financial institutions, which got accelerated after the repeal of Glass-Steagall, and you ended up with bigger and bigger banks And those were the financial institutions that were really innovating, and not too much good was happening for the consumer. And of course, we all know how this ended in a pretty spectacular failure in 2008. And it's not surprising that financial innovation became a dirty word, and people started to question the value of financial innovation as a concept in general. And it went from politicians to pundits, but I think really a lot of consumers too started wondering whether any of these things that were being invented in their financial lives were actually going to do anything good for them. In the meantime, during this period while the banks had been making money hand over fist and delighting their shareholders and keeping regulators captured and happy, technology entrepreneurs were busy tackling challenges, but they weren't doing it in the financial industry. They were using the internet really to fundamentally change a number of industries, from publishing to commerce to starting to change professional services with software. And financial services, the world's largest industry, remained basically untouched during this period. And it makes sense. It was if you wanted to start a fintech company or a financial services company, you spent the first 2 years of your life in the lobby of banks, and the banks were making a lot of money and were really actually quite hard to compete with during this period of time. Paul Volcker, he's this quote. This is actually this is a pretty searing indictment of financial innovation. It captures a lot of what people were thinking at the time. He said the most important financial innovation of the last 20 years is the ATM. And actually, when you think about it and you look at what happened between 1990 and 2008 and the crisis, this is actually a pretty good point. So you then think about what's happened after the crisis, and banks and government has been very, very busy, but they have not been busy innovating or creating things for consumers. Banks have actually just been busy trying to get their own regulatory and balance sheet capital problems under control. Some very smart entrepreneurs have started to recognize this as an opportunity, and the economy keeps changing. Consumers and businesses keep having new needs, experiencing technology in new ways. And so financial innovation coming back, but financial innovation is coming back in a different way. But it's making headlines again. But these headlines are coming from a different coast, from this coast. Well, I'll say from Silicon Valley, because Silicon Valley now I think of more as a state of mind. It's actually happening in capitals of innovation all over the world. But the people who are shaping the conversation around financial innovation are not the banks, but are actually technology companies. And we know this is true, must be true, because we have the sort of high priest of global capitalism himself, Jamie Dimon, saying that he's worried about Silicon Valley. He's seeing how there's real innovation coming from technology entrepreneurs. This is not something you would have heard bankers talking about, even really in the internet bubble. I guess if I talked about these sort of first two eras of financial innovation, the era of democratization and the era that I cynically called exploitation, I'd like to call kind of this next era that we're in now, I call it internet finance. I was just this week on a trip to China meeting technology entrepreneurs who are working on financial problems. And in China, everybody talks about internet finance. In the US, people use the term fintech, but I think the term fintech is a little outdated. To me, it means building software and selling it to banks. I mean, there were entrepreneurs who have been doing this for a long time, but what's happening now, you're seeing entrepreneurs who have much bolder agendas, who actually want to go and own the experience that the customer has, want to have a relationship with the consumer and build new brands themselves. They're not taking a backseat to the traditional institutions. And you had some very intrepid entrepreneurs who did this in the first decade of the 2000s. There just weren't that many of them. If you look at what's happened in the last few years, there's been a sort of huge swell in the activity around creating these new companies and new brands. Of course, the venture capitalists have taken note. VC investment in the space, historically has been far, far under-indexed relative to the size of financial services. Now, venture capital has gone up in general during this period, but this growth from 2009 to 2014 is more than double what you've seen in VC in general. So let's this just be about the opportunity for entrepreneurs and venture capitalists to make money. I want to talk about kind of why, in a way that may be a little bit Pollyannish, but I still think is directionally correct. Why I think the internet is starting to do what the internet does best, and how that is creating this wave of innovation that is really sort of positive, has a lot of positive implications. And the things, if I had to say, what does the internet do? The internet reduces information asymmetries. The internet tends to empower customers. The internet tends to let great products win, or great products get access to distribution that they didn't have in the past. And all of this, to me, the way I think about it is, in this period of time, we're seeing more financial innovation and less financial engineering. That's sort of my tagline for you. And what does this mean? It means greater transparency, lower cost. It means more accessibility to products. A lot of what was started in the 70s and 80s with liberalization of interest rates and sort of the U.S. coming out of this era of inflation now is being consolidated and revisited. So many of those great innovations are now being turned into great innovations minus some of the problems that had developed with them. I'll give you some examples of companies, some of which we've backed, others which we haven't, which I think are capturing the spirit of this real financial innovation and not sort of engaging in some of the financial engineering that we saw from banks and companies prior to the crisis. So Wealthfront, a company, in full disclosure, in our portfolio, and that I'm a huge fan of, drastically lowering the cost and actually doing it while offering what I think is indisputably a better investment product. Credit Karma, another company in our portfolio, is an example of companies just making finance, which where the provider has historically often benefited from complexity, is able often to extract more rents when the product is more complex. Many of these new companies are trying to make the products simpler, and Credit Karma is an example of this, demystifying something that to many consumers is really baffling, and which is their personal credit data, and giving that data back to them and saying, to the consumer, you own this, let me help you figure out how to use it in an intelligent way. Then making products more transparent. To me, transparency may be the most important sort of word of all, and a lot of what was lost in the period prior to the crisis was this transparency, a sense of where risk was being shifted, and this got sort of embodied from the customer in very complex pricing. An example of how it was embodied was very complex pricing schedules. So on the left here, you see a typical pricing arrangement from a merchant acquirer. I mean, anybody who was accepting credit cards 10 years ago will tell you this is what they were given before they signed up, in a 2 to 4 week process of underwriting for credit card acceptance. Today, companies like Stripe and Square are doing that underwriting instantly, and they're giving the consumer a very simple, transparent price. And then, a lot of people are working on making financial services less intermediated. So on the left here, you've got a famous RMBS structure from a bank in Long Beach. On the right, you have the very simple way that Lending Club, which is sort of the warhorse of this type of business, is directly connecting borrowers and investors, fundamentally the same process. And there's still plenty of complexity that is in this process, but it's being reduced all the time. I think when, like other systems, but especially in finance, when you reduce steps, when you make things less intermediated, the systems become less lossy, by which I mean fewer crumbs fall off. You have fewer, not just fees, but fees is a big part of it, but also less data is lost. And that all feeds back into this effort to create more transparency in the system, which I think is a very, very good thing. So I'll try to transition here for a second. I'll try to talk about why this is happening and where the opportunity is coming from a bit. I think you'll hear about this from all the panelists who talk today. But I'll contribute a few ideas and see if it generates a reaction for you. So the first thing I would say is there's sort of the rise of the millennials, or Generation Y. And I think this is important in the way that any new generation that comes in, but these are people who grew up as native digital, or I don't know exactly what the right term is, but basically they expect something different from the products and services they engage with than traditional financial institutions are providing them. 60% of millennials say that financial products are not built for them. A third actually believe they won't need a bank in some period of time. And this is an enormous group, over 1.5 billion people worldwide. So this is a really big new audience for entrepreneurs who think this way to go after. This has been talked about ad nauseum. I'm sure all of you have thought about it, heard about it, but not really enough can be said about the potential of mobile technology and how it's impacting all walks of life, but not just for us in the U.S. because we're staring at our cell phones too much. I mean, the number of bank accounts in the world today is going to be dwarfed by the number of smartphones and connected devices in the world in a few years. And this means many people who have actually never interacted with a formal financial system will be reached through technology products. And these people are up for grabs by new brands who are able to figure out how to underwrite and serve them in more effective ways. The second thing, which is related to mobile, is because you have this new technology that many new people are using, you have huge new open distribution channels that we've seen 3 times growth over the last 2 years in the number of app downloads around finance. It's not the sexiest category in the App Store, but people use it a lot. People have been making good use of the channel. And one reason this is kind of remarkable, you think about the financial brands that exist today. Many of them have been built over decades or even 100+ years. And now in the App Store, which is becoming maybe the most critical distribution channel for a lot of products, you're seeing brands that were created in the last few years start to exist there. So we have this window. Brand is very, very valuable in financial products. You have this window for companies. Here we've got Wells Fargo, founded in 1852, on the same screen as Credit Karma started in 2007, or Venmo started in 2009. Yeah, it's good. It's a good point. Well, this gets to that point, which is in 2014, 4 of the most hated brands in America were financial brands, and a lot of this is a legacy of the crisis. A lot of it is just lack of innovation from incumbents, but what you see is receptivity from consumers to new brands. So companies like Lending Club, or these are a couple of our investments, Conta Azul and Funding Circle, they have relationships with their consumers that would defy anybody's expectations around how consumers talk about their financial experiences. But Funding Circle, as a small business lender, they're able to underwrite a loan for small businesses at a very low rate with often a long duration, so this is real investment capital, and they're able to do it in a really short period of time. And this is just so fundamentally different from the experience many small businesses had around getting a loan in the past, when they spent 2 months groveling to bankers and in the end ending up being turned down. And of course, Silicon Valley, I think, and Silicon Valley everywhere, is doing what it does best and using software and data to really innovate around consumer products. So this is a famous chart that Lending Club has been sharing with everybody on the left side to basically show how they originate loans. And a lot of this is process, but when you start thinking about how, say, for example, how to originate a personal loan, or on the right, this is from a company that does lending in emerging markets on mobile phones. When you start thinking about how to change the process or use data in new ways, and when the cost of the software and systems that you need to do it become much lower, the tools in the hands of entrepreneurs are just a lot more powerful than you've seen in the past. And so kind of the fun starts, and this is what entrepreneurs who we see all the time now, just in the last few years, have really started to do: go and pick away at all of the things that banks do as a place to start, picking a consumer need that's underserved or unmet, and starting to unbundle the banks. And some of this is happening really fast. I mean, it's happening at the speed of mobile and web. On the left, this is Yuebao, is Alibaba's or Alipay's money market fund, and in maybe the most remarkable thing that's happened in financial services in the last few years, all through its mobile app, the company became the 4th largest money market fund in the world in a year. Now, a lot of this was driven by a sort of blip in Chinese macroeconomic policy, but still, the idea that this many consumers with this amount of money through a mobile product started by an internet company would trust putting almost 90 or almost $100 billion worth of funds is really kind of an amazing thing. And here in the U.S., where with a longer-term investment, with a true investment offering, you see Wealthfront, basically getting to $1 billion 3 times as fast as Charles Schwab, and that growth has continued quite a bit over the past year. So I'm going to sort of tell you why I think it's still early days, lest you think that with all this innovation, there's not a window for the students and for other people here. I want to encourage you to think about being part of this, because I think this is a really important, potentially lucrative, but also just valuable and productive area to spend your time on. If you look at the lending market, for example, the market's enormous, and while we hear a lot about Lending Club, that's backwards. We hear a lot about Lending Club and OnDeck and Prosper and other companies like this. We're really, we're just scraping the tip of the surface here. So almost $3 trillion in originations just in the U.S. and $17 billion attributable to any of these new platforms. So it's really very, very early. And I would say this about financial services in general. This is our most aggressive estimate of what online finance, these internet finance companies, what how you would value them at $120 billion, which is still low single digits in terms of the overall population. So for the students, one thing Ward had asked me was, what does it take to be in this industry? One thing I love about this, when I was coming out of college, there was always, you would hear, kind of lamentations from the press and from professors about how many of their top students were going to Wall Street. And this debate always kind of rages on, but a lot of people find finance to be a really interesting and impactful topic. And I think now, I believe with this wave of financial innovation, with the growth of internet finance, you kind of have the opportunity to do both. But the skill set that you need and the way you think about the world is different if you want to participate as an investor or as an entrepreneur or go work at one of these companies. So you have to be passionate about software and products. You have to think about product. You're no longer allowed to just spend your time in spreadsheets. But you also have to be comfortable with interfacing with the formal financial system. So a new thing we're seeing from entrepreneurs is the willingness to engage with regulators and bankers. It takes a different type of person to both, in one breath, think only about technology and always be pushing the envelope, and then to interact with people who have their concerns. And then lastly, whether it's, too much is made of big data often. It's a great buzzword, but actually, data is becoming critically important in every component, whether it's small data or big data in financial products. I think often as much in marketing and identifying and finding customers as it is in underwriting, but being fluent with using data tools is really important. So with that, I'll take a break. I'll answer any questions if people have them, but thank you again for having me and for being interested in this space. I'm, again, it's maybe it's a Pollyannish view that I have, but I think something very big is happening here, and I'd encourage you all to be part of it.
Do we have questions?